Hello everyone and welcome back to Finance for JCL, the show aimed at new and intermediate level investors. Thank you very much for taking time out of your day to view this show. Today's topic of discussion is return on equity and why it's a key investing metric that will help you achieve financial freedom. So let's crack on. The reason that I'm producing this show and looking at return on equity is because it is very much an important metric when you're assessing individual companies for a potential investment and share purchase. And some have said that it's actually Warren Buffett's favourite number, so it sounds like it could be fairly important. So the objectives for today's show would be, first of all, for me to explain to you what actually is return on equity, how it can be calculated. The second objective is to then show and explain what it actually demonstrates. So you've calculated the number, but what does it mean? And the third one is how that number could be used as you review individual companies for potential share purchase in the future. So moving on, first of all, what is return on equity? So the top level calculation is it's the net income divided by the shareholders' equity. So the net income you'll get from the profit and loss statement or the income statement, and the shareholders' equity figure is a figure on the balance sheet. Now, if one were to break that down into a per share basis, you're effectively saying how much is the company earning for each share, and then that will be divided by the book value per share. And that is the calculation for return on equity. So to bring that to life a bit, I'd like to share an example with you. So you have company A. Company A has a book value per share of 20 and makes profit, and the earnings per share in this year have been 10. They're not going to pay out a dividend or buy back any shares, and therefore their return on equity is 10 earnings per share divided by 20, their book value, so that is 50%. In contrast, we have company B. Their book value per share is 200 and they make exactly the same profit per share of 10, and again they don't pay out a dividend, they don't buy back any shares, and therefore their return on equity is earnings per share 10 divided by book value per share 200 is 5%. I've purposely chosen company A and company B to both have earnings per share of 10, because what that demonstrates is, we can look good, $10, £10 earnings per share, but you need to compare that to the book value that earnings per share is being created from, and you can see we've got 50% is the return on equity of company A and 5% of company B, so that's pretty different, and that could lead to a different conclusion as to whether you invest in that company or not. Summary, company A has been very effective in using its assets in order to generate earnings, and company B, although perhaps it's been less effective, it may actually be more suited to paying a dividend, so it's not very good at investing back into the business and generating returns, so why not actually pay that money out to shareholders as dividend instead? So the way to use return on equity in investing decisions is, first of all, for me personally, my minimum return on equity is 8%. So if the company has a return on equity of lower than 8%, I will not buy shares in it. Now, this is just the level I've come to myself. You may assign a different minimum threshold based on your own investigation. I urge you to look into that. And then linked to my minimum of 8%, I have a desired return on equity of over 20%. So for me, it's a pretty strong company if that figure's clicking in at over 20%. Now, having a figure of over 20% demonstrates a really impactful and effective management, generating returns from the company's assets. So that's a good sign. And this return on equity is calculated on many investing websites. You'll be able to find it. And I get it from Morningstar.com or Simply Wall Street, two good sites. And perhaps the way you could use it is actually not just look at the individual company's return on equity, but to compare it against its competitors in the industry, so you can see which companies in the industry are the most effective at generating returns from their assets, and that could indicate potentially the long-term viability of those businesses. Now, 2 words of warning: do not calculate this figure if the profits are negative or the shareholder equity is negative. It doesn't quite work then. And you can also have really high returns on equity, over 100% sometimes, but take a bit of care when you see that. It doesn't necessarily mean it's amazing. It could be that the company's got really high debts and therefore the equity figure is particularly small. So keep an eye on that one. So that's how one would use return on equity, potentially investing decisions. But I would say, if you're unsure about this, do your own research, take some professional advice in order that you're using it in the right way. So in a summary for return on equity, I believe that return on equity is absolutely a key investing metric, and I consider it for every potential company purchase that I make. Companies with high returns on equity, generally more attractive long-term investments, and they've got good management. That's what it would demonstrate. Companies with low return on equity, it doesn't mean they're terrible, it just means actually they have to grow shareholder value in other ways, and that could be via dividends or indeed buying back with their shares. So that concludes the show for today. Thank you very much for watching or listening. I look forward to seeing you on the next show. But in the meantime, if you could hit the subscribe button if you want to find out more information of this nature, or indeed if you found this video or show very useful, please do hit the like button, and that will help the show be shared with more people. So thanks for your time, and I'll see you soon.